Welcome to another Market Insight Call, where we sift through the noise to get to the signal, give you actionable advice so you can make informed decisions. Joining me this month, like every month, is Chris Ahrens. Chris, are you enjoying the change in the weather?
I am. It's been nice. The weather's kind of round tripped a lot like the stock market has recently. So if you haven't checked your account in a while, you may not have noticed. But if you're checking every day, there's been
a lot of movement, right?
A lot of movement.
Similar to the temperature here in St. Louis.
Yes.
Well, why don't you tell us about what's going on?
So we'll go through market technicals. I have a stat that I know you're really going to like. And we'll go through the similar three things that we've been talking about because it has what's caused this round trip with Treasury issuance, a Fed meeting, and inflation. We'll go through some scenarios of how we see where the market's going. Close out with earnings. Originally, I was going to close out with government shutdown when I put these slides together yesterday, but that's already changed since then. Looks like they're going to avoid a shutdown. The House has passed something. I don't know if it's made it to the Senate yet. I don't know the Senate plans on that, but it looks like they have the votes. And again, we talked about this last September, that they were kicking the can till now. Looks like they'll kick the can again until January, so the same slide we have there, we'll probably be talking about it again in a couple months.
Yeah, it's a reoccurring drama for sure.
Yeah. But let's look at the S&P 500. We can go back to the start of this chart in the upper left. That's July to a couple weeks ago, the end of October. It's a 10% correction. So does hurt when you see the market down 10%.
Absolutely.
But it happens every year. On average, the average drawdown is actually over that because you get some of the tails from the really large drawdowns that are more than 10%, but median drawdown is 10%. So it's really expected, typically, every year to have a drawdown like this. And really our last meeting started with this red box. A lot of uncertainty was going on in the market. Rates kept rising. We'll talk about that. The stock market was really hostage to interest rates. And there was a pullback. Technicians were selling. Earnings season was okay. I think it was better than a lot of people thought, but some of that had an effect on the market. Companies couldn't buy back their stock. They're in blackout periods. That's changed since the earnings season ended. And we had a couple breaks where the market broke below some technical levels, which created some sales. And really looking at it, we really needed a fundamental change, some news for the market. Circled in green, we did get this. Starting in November, we had an FOMC meeting that seemed to be positive. They were acknowledging how high rates have been and that they probably don't need rates to continue to rise as much. We had Treasury issuance that was okay, and job data that showed growing jobs, but nothing really inflationary. So we got those really strong 3-day rallies. And I'll clean up this graph one more time to show. Yesterday, we had CPI, large gap up. Inflation came in at 0. We had this significant gap up above to get back to really the highs from September.
So when you're saying gaps, you're talking about how there's just a big jump and a big space in those candles. They're not overlapping, which is something that technicians look at, and we don't have to get into the weeds, but it could be either way, right? It could be that's a bad omen or that's a really good omen. You want to add a little bit of clarity to that?
A common line is that gaps get refilled.
Right.
And because there is some pullback that happens and you get back to those gaps. Now, when a technician looks at a gap, they call it a breakaway gap. It's really a change in trend. So if a change in trend has happened, say it's interest rates. Interest rates have really been trending higher and have stopped. They've come back down. Now they're leveling out a little bit below where they were. If that's a change in trend that holds, a technician would say this is likely a breakaway gap and going to continue higher. At least those lower gaps, the most recent one from yesterday, that could easily get refilled. That just happened pretty quickly.
So that sell-off that we talked about last month is really kind of that pessimism of I don't think things are going to work out well. And then just hitting those expectations, that's a change in trend. So they're saying, well, it's not as bad as we fear. Let's go ahead and place those bets. It's actually done what was expected, but when we were selling off, we were thinking it was going to be under that. So it's actually intra-market, they're beating expectations at this point. So it's changing that trend.
A lot about expectations. We'll talk about that, especially when we talk about earnings. Just to close out, the bottom panel, we can throw back up here, the RSI. It's a short-term trading mechanism that people use for timing. Nothing we're going to use, but just to acknowledge that typically it stays in a range of 30 to 70. It does break out when it's above 70. Likely say the market's overbought in the short term. It's only a 14-day measure, and oversold in the short term when you're around 30. And the 30 did hold for the sell-off that we had at the end of October. And so we're getting close to the overbought 70 metric. Just simple, people will take profits when that happens.
And though we wouldn't be doing it off of the RSI, that actually would probably coincide with some of the trend lines that we look at when we're raising cash. We didn't raise cash here recently because we haven't been above trend line, but with this rally, it's a good chance that we would, and we would start to actually add cash in addition to the quarter that we spent down, which could be very helpful going into an election year coming up. So we would be at a 24-month cash buffer going into this.
The line you referenced, I don't have the chart. We're right at it. Really preparing. Is there going to be a breakout higher that says it's probably a good time to start raising that cash, you said, or good potential small pullback? And really, what this has been, it's been interest rates. Right. Complicated looking slide. Just two things I really wanted to point out. The blue line, 10-year Treasury rate, was moving up very fast. That was what was causing a lot of that sell-off. Well, we've seen that come down from those points that we'll talk about further, and the market responds nicely to that. That's the bottom line, that correlation, negative correlation, basically saying when rates are going up, stocks are going down,
right,
or rates going down, stocks were going up. I think that's going to continue to hold. We'll show in our scenarios that there's some times where that scenario won't hold. So, but I do think at least in the short term, the market is still going to be following
for the most
that.
part, it has to hold because that's the way that you're discounting future. So if the way that you're discounting it increases, meaning the interest rates go up, you're going to discount the stocks initially more. So that relationship is going to hold for the most part.
If you're growing cash flow significantly from your company, right, then
right,
you can outgrow that.
And I think that's been consistent with what we've talked about here is this story is all about the interest rates for the last year or so. It's all been driven, any movement has been driven by the rates.
And I said I'd close with one interesting stat that technicians follow. And first, we do talk a lot about seasonality. This year has followed pretty closely to what you'd expect seasonality-wise. Beginning of the year is strong. That's typical. Some pullback in spring, strong rally into summer, and then the hardest months are August, September, October. It's exactly what we saw, and then strong recovery towards the end of October. That's really, when you look back, what you typically see in the market. So what I'm showing here is what happens when there's a over 5% increase in the stock market year to date, so from January till the middle of November, so right where we are. Over the last 50 years, 26 out of 30 times when you've had that 5% gain, you end the year positive. And those 4 times where the market was down or up top on our graph here, they were small, 1% decreases. Last 22 years, every time the market's been up 5%, we did have positive returns through the end of the year. It's a little bit funky of a stat. Technicians follow it. It's potentially something just to say, hey, when you're up, you have that trend, enter a good, strong seasonal period, Santa Claus rally that we talk about. Maybe this can help start that trend.
And for the most part, I think we're just looking at history. It's happened. I don't like the word always on there, but I think there is some causal relationship, right? If the market is up by the end of November and you just had a sell-off September, October, there's that wealth effect. You feel a little bit wealthier and stocks have kind of sold off. I think that makes sense, but I would also say that most of the time when there's a red light, cars stop, but I wouldn't say all the time that there's a red light, there's car stop. So I wouldn't make too much out of that, but I think this is a good, strong indicator.
Yeah, it's something we track, and those sell-off that happens in the end of the summer isn't even agreed upon why that happens. You know, we have our reasons of what we think causes that, but not everyone agrees. But it is something that we do see, at least from a technical standpoint.
Right, and from a pragmatic standpoint, if it is consistent and its accuracy and it gives you good things, why wouldn't you use it?
Yeah. And then let's just go look at what's been causing the rate movement. And this is Treasury issuance. So this is the one thing that's a little bit concerning, because every time we've been seeing Treasury issuance, there's actually, I don't have the charts, but equity volatility is up significantly on days where the Treasury has a Treasury auction for their bonds. And what we can see here is the refunding came out at $112 billion. Expectations, which you talked about, expectations or lowering expectations, were 114. That was enough to say we're a little bit below what we thought was going to come on in new supply. The market did continue its rally that we talked about earlier. The other thing they were afraid of is that they were going to continue issuing long-term bonds, which really affect the discounting measure that we're using on the long-term rates, when they really focused them on the short-term rate. Something where the market probably got too pessimistic. Treasury sees these auctions. They know they're going just okay. These auctions have not been described as really aggressive and strong for the Treasury because the demand just isn't as strong as it has been in the past. So they know that, and they've been choosing to issue short-term debt instead. Well, the market wasn't sure that that was going to happen, and we did get a rally once we saw that the auctions were going to be more short-term focused.
Right. So once again, it was better than it was expected, which is better than expected based on the thing. So why don't we talk a little bit about interest rates then? Because I think I've been wrong. I said the Fed wouldn't raise the last 2 times, and they didn't listen to me. They continued to raise interest rates. It's all their fault. But we're seeing good numbers on inflation, and we're starting to see the market actually price in that we would have 100 basis, maybe even 200 basis rate cut by the middle to third quarter of next year, which I think is very optimistic from a market standpoint. You want to talk about that?
Yeah, very optimistic. So we plotted here are 3 lines. The black dotted line is the Fed forecast, and that's from 2 meetings ago. So this meeting where they came out and continued pausing rates was not a projection meeting. They released their projections every other meeting. So we didn't get anything new from their forecast. Then the November 13 pricing is just what the market was pricing in on Monday before CPI, and then 14th was once we saw that low CPI number, which we'll talk about in a second, repricing down expectations for rates in the future. And what you're saying is, we look at where our rate's going to be at the end of next year, market's expecting about 100 basis points of cuts, which is pretty significant. While the Fed's saying, those 2 increases that you didn't think were going to happen, they're saying we'll pull those back. They probably didn't need to raise those extra 2 rates, like you said, and their forecasts are to just pull back a couple of those rate increases next year. So really the question is, if that doesn't happen, the market has priced in a lot of cuts. There's a lot of time to reprice this, but could that mean a decrease in equity prices as they try to reprice in that the Fed's forecast might actually be accurate?
Well, I mean, certainly if they were to raise beyond expectations, we'd see a drop, but I don't think that's bad. We were talking about it before, where if we can maintain these interest rates long term, that's actually going to make a more productive economy. You're going to have a lot less consumption, a lot more investment. You're going to have people placing those into the bonds to get higher yields. So if we can tolerate that as an economy, we don't go into recession, that actually would be strong. And what happens is you get that initial drop because of the repricing, but now the growth rate that you're discounting at is a faster slope so that you would rally out of it. I'm not advocating what they're going to do, but it wouldn't be the end of the world. We'd just see probably another speed bump in this process.
Yeah, I think that's a really good point. Just to look at the CPI number, won't spend too much time on it. The top panel is monthly change in CPI. You don't see it for October because it came in at 0, which is below the trend. We had a couple, August and September were significantly higher than trend. A lot of energy prices. The energy had come down, something you can follow gas prices pretty easily. Coming back down to get back to that trend, which since May, 0.1, 0.2, 0.2, break above trend, coming back down. That's really why we saw this strong rally in the market yesterday, where everything was pretty much up. Some over 90% of the stocks in the S&P were up. Small caps were up over 5%, significant rally. A lot of people were shorting them, so certainly there's a short squeeze aspect to it.
There's been so much pessimism in the market and the hedge funds being short. Those gaps kind of explain that. If you got a 5% rally in small cap and you're short, that's painful. You got
to close your short, and you're price insensitive buyer. You got to pay whatever you can get it back for. But what you were kind of referencing earlier is that spread, which is that Fed funds rate is pink. We've tracked this chart multiple times, and these are those same inflation rates or charts that were on the previous slide, where we have core and then just the headline, where we're at 3% and 4% for prices year over year, and we're still much higher on the Fed funds rate. So the question is, cutting Fed's funds rates, we're going to have to see that there's still that spread. So they're not going to pull off a bunch of interest rate increases unless we continue to see inflation trending down, and they can continue to have this spread where the short-term rate is higher than inflation rate.
Right, and I think there's been a theory that has been held for a long time, up until the last couple of decades, where you would always need a positive yield above inflation. But we've certainly had plenty of times where the yield is below inflation. We've even had some instances where we've had negative yields globally. So I think that's going to color the Fed more, and I don't know that they're necessarily going to see a need for a spread. If we have inflation coming in at 2-3%, I think that Fed funds rate is going to be really close to that inflation rate, which gives more ability for them to cut a couple of hundred basis points to bring it back in line with inflation.
So let's look at what those outcomes would look like when we're trying to look at a scenario analysis. We'll start with where we have probability, the least probability. So calling it steady economic growth, that's really a continuation of above trend GDP. So GDP somewhere between 1.5% to 2.5% growth. Last quarter was almost 5%. So no one really has a high probability on this. And this is what happens when you get a really strong number like we had yesterday. You got to reprice this in at least some part.
Right.
And you're going to get people buying stocks because they had a 0% probability on these strong economic moves, and we get something that's positive for the market. You get a strong repricing. So this is that scenario that I referenced where if we keep having growth above trend, interest rates will probably drift higher. And equities can also go higher. It doesn't have to be because you're increasing your cash flows that are coming in. Now this is that scenario where bonds are actually going to go down as we had rates moving higher, but our equities should be moving higher as well. And so we're less concerned about those bonds. And the bonds that would outperform would actually be really, really risky bonds, high yield bonds that don't actually have any duration. They're floating rate. We haven't purchased any of those, and because of things we'll talk about in a second, we don't plan to. Right. Those are bonds that would have zero hedging in terms of if there were a recession.
Right. And though we're talking about this being the lowest probable, you did mention how high the CPI came in on this last print, which was 5%, 7%. Now, I don't know that I necessarily believe all of those numbers. I think the inflation is understated. So maybe it's around 3 to 4. But we did take a deep dive into those, trying to understand, was it exports that increased because of the dollar, et cetera? And it was across the board. It was a strong economy. So though the market seems to price this in as a low probability, the most recent CPI says this is a pretty strong probability. Mm-hmm. Maybe the market's a little too pessimistic on that probability of that happening.
Absolutely. And that moves to recession. Somewhere around a 20% probability of recession. In recession, rates are going to come down. That means we're probably going to see a shift lower in rates, not really a steady decline or steady increase. It'll happen pretty quickly. That's an increase in our bond prices. Mm-hmm. Bonds I have listed here, government bonds. We hold a lot of government bonds. They're not as risky as some of the other bonds we talked about. They don't have that credit risk. That's going to provide a hedge to our equities. So that's something where we say 20% probability, it could happen. We need to start making sure that's making it into the way we're creating portfolios, which is why our fixed income allocation right now is what we would call high quality. Now, the equities that outperform in recession are staples, utilities, healthcare. Now, our view on the recession is it won't be, if it does happen, it won't last very long. Mm-hmm. So the move into those equities would probably be short-lived. So it's something we're really not putting into how we create a portfolio on the equity side of least.
Because we're so high on the interest rates so quickly, if you reverse that because you have the room, we're not talking about 2% and going down to 1.5%. We could easily go from 5 to 4, mm-hmm. And that would change that scenario quickly.
Mm-hmm. And then the most probable scenario is that soft landing where GDP comes in around 0 to 1.5%. Well, interest rates probably drift a little bit lower, which means our bonds are going to outperform cash. So we've had two scenarios now, recession and that soft landing, where the cash equivalent rate, which seems attractive, right? It's those high short-term rates that we're talking about, probably underperform our bonds if rates are drifting down. So starting to like bonds as an asset class, at least on some allocation, and similar equities that we think will do well in strong economy as well, which we've allocated to technologies, some of the cyclicals like industrials and discretionary.
Right, and as we're going in, we've talked about the election year. What tends to happen is that's a good year for the overall market. Now, it usually is that a president that's going on there's probably a little pressure placed on the Fed because they want to get reelected. And I don't know that that's exactly going to fit this time because we're just coming off of inflation. But once again, we're talking about how the Fed could reduce. So I think there's a strong likeliness that we have a pretty decent 2024 whenever we're looking at monetary policy, and the most likely direction is lower rates.
Yeah, we'll start talking probably a lot more about the political outlook in the next coming calls.
I'm going to skip those calls.
Yeah, I'll do them alone. I have some good slides that talks about exactly what you just said. What happens when you have a sitting president trying to get reelected, and at least historically, the last year of their presidency, it's always had a positive
Right.
outcome, at least for that year.
In their first term.
Yeah, when they're running for re-election. Finally, we'll close with earnings, because this was really seen as just an okay quarter. It was better than expected. It goes back to what you had said in terms of expectations. When we look at entering the earnings season at the beginning of October, what we expected in terms of earnings from the index was right there around 56. And to close out the earnings, we kept getting increases. Companies were outperforming and closer to $58 a share when we look at a bottom-up blend. And that really ended up being a beat rate of about 81%. That's in the black line there. It's similar to trend, at least in the short term, a little bit higher, but it's really, long-term trends are somewhere around there too. And if stocks sold off because they weren't expecting this, you'll see a lot of bears on TV that come on and they'll say, they're beating really lowered numbers, which is true. Numbers had been lowered and they did beat those numbers, but a lot of that was already priced into the stock. So when you're still beating these expectations, you are still seeing some move higher. What you can't do is not beat lowered expectations. That's been really painful the past couple quarters as we've seen expectations come down. If you miss, you're punished a lot harder than at least in the historical.
Makes sense.
And closing out with profit margins, almost 12% on the last quarter. It's breaking the trend of being a little bit below that, which is actually a really good sign. We can see forecasts going forward that we're going to hold somewhere around the 11 to 12%. That's going to be something to watch if that's not holding, and that's coming back to where we've seen in the past quarters, closer to under 11%. That's something that would be a risk to the market. But at least where we're seeing it now, looks positive for maintaining that 11 to 12%. And our final slide, which we don't need to show because last night it looks like the House is going to pass a short-term funding bill, and we'll bring this chart back out early in January.
Well, anything else that we want to cover?
That's everything.
Well, really appreciate it, Chris. And if you haven't done so already, down below is the subscribe button. Go ahead and hit that subscribe button so you continue to hear about the updates on how Congress will continue funding the government. So if you like that they don't shut down, go ahead and hit that like button, and make sure your friends get to watch us continue to talk about shutdowns by sharing that through that arrow. We appreciate you coming in this month, and look forward to you next month.